Should you let a blindfolded monkey manage your money by randomly throwing darts? So, how many of the monkeys do you think beat the overall market each year? Maybe 25%? 50%? No, they did way better than that. And once again, the animal kingdom had displayed its dominance over the financial world. But did you know that when you narrow the scope to just the last 20 years, even the great Warren Buffett has slightly underperformed? Hi, I'm Khalid Shamim, a wealth manager for expats living in the GCC. And I have one question for you. Should you let a blindfolded monkey manage your money by randomly throwing darts? No, of course you shouldn't. That would be ridiculous. Or would it? Because in this video, I'm going to tell you the strange story of how a blindfolded monkey beats some of the Wall Street's top financial minds. Plus, if you watch to the end, I will tell you the secret way of investing that I use to ensure no matter what happens in the market, I make money in the long run. And it starts with one man and his monkey. Let me tell you about a man called Burton Malkiel. Burton is a professor of economics at Princeton University and for 28 years was the director of Vanguard, one of the world's largest investment companies. But he's probably most famous for something he said in his classic finance book, A Random Walk Down Wall Street. Now, just to give you some background first, Burton Markiel is a big proponent of something called efficient market hypothesis, which is a belief that share prices quickly adjust to reflect all the available information, and so they trade at their fair market value. Therefore, without insider trading, it is impossible for investors to buy undervalued stocks or sell overvalued stocks. The stock market are entirely unpredictable and you can't outperform the overall market through expert stock selection. Then, by following this way of thinking to its logical conclusion, Burton said something pretty controversial in his book. He said, a blindfolded monkey throwing darts at a newspaper financial pages could select a portfolio that would do just as well as one carefully selected by experts. Naturally, this upset quite a lot of Wall Street people, especially the heads of actively managed funds, whose entire reason for being is that they promise to help investors like you beat the market. The idea that any monkey, let alone a blindfolded one, could pick stocks better than them was outrageous. After all, they can do all these complicated stuff like factor regression analysis to calculate the expected returns of any stock. How could a monkey ever hope to beat that? Well, studies were done to find out for once and for all who would pick better stocks, investment professionals or a blindfolded monkey randomly throwing darts at the pages of the Wall Street Journal. These studies were done by an investment company called Research Affiliates, and you can read their paper yourself by following the link in the description below. But I'll just summarize it for you here. Every year for 46 years, the researchers randomly selected 100 portfolios, with each portfolio containing 30 stocks randomly chosen from the top 1,000 largest stocks by market capital. This process replicated 100 monkeys throwing darts and randomly selecting a 30 stock portfolio every year. Probably because giving a monkey actual darts to throw around was deemed too risky. The researchers also formed a wide variety of rival portfolios by following popular stock picking strategies. And as a benchmark to measure everything against, they also formed portfolios that contained all 1,000 stocks weighted by market cap. So, how many of the monkeys do you think beat the overall market each year? Maybe 25%? 50%? No, they did way better than that. On an average, 98% of the random monkey portfolios beat the benchmarks. And while some of the stock picking strategies did do slightly better than the monkeys, many of the most popular ones actually lost and did worse. And in the end, the researchers concluded Malkiel was wrong. the monkeys have done a much better job than both the experts and the stock market. And they further added, many of the plausible investment beliefs held by investment professionals are nothing more than good stories. Blindfolded monkeys aren't the only animal to do a better job at picking stocks than professionals do. Back in 2012, the British newspaper The Observer decided to pit a team of 3 professional stock pickers against an orange cat called Orlando. The challenge went like this. Each team was allowed to invest £5,000 in 5 companies from the FTSE All-Share Index at the start of the year. Every 3 months, they could exchange any stocks, replacing them with others from this index. And after 9 months, it looked like the professionals were going to win. With their principal of £5,000, they had generated £497 of profit compared to Orlando's £290 profit. But then disaster struck. In the last 3 months of the year, there was a sudden reversal of fortunes, and the cat's portfolio increased by 4.2% to end the year with £5,542 and 60 pence compared with the professionals' £5,176 and 60 pence. That meant at the end of the year, Orlando the cat had made over 3 times more gains than the professional stock pickers had. And once again, the animal kingdom had displayed its dominance over the financial world. So why do animals do so well at picking stocks? Some claim it's because when you randomly pick stocks, you are much more likely to pick ones with smaller market caps. Small caps will go up more than the overall market, but the trade-off is that you are taking more risk because you can go down more than the overall market too. In fact, Burton Malkiel himself admitted sometimes small cap stocks outperform, but they can underperform for years. And that's probably why Burton himself is a great proponent of investing in index funds rather than randomly picked portfolios or actively managed funds. It's less risky. Talking about why actively managed funds generally underperform, he said in an interview with CNBC last year. People fool themselves when they see apparent patterns because streaks are more memorable than randomness. And he went on to say, Standard & Poor's publishes annual reports showing how actively managed funds compare with index funds. Each year, about 2/3 of active managers underperform an index funds, and the 1/3 who outperform in one year tend not to be the same as 1/3 who outperform in the next. When you measure performance over a decade or more, 90% of active managers are outperformed by a broad-based index funds. On average, active managers underperform the market by about 1% per year. In other words, Burton says changes in stock prices are random and unpredictable, and that you probably shouldn't trust anyone who says they can help you outperform the market.
Number 1 rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, fugazi. It's a fake.
Yeah, fugazi, it's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
When you don't know much about investing, it's very tempting to put all your money into the hands of someone who seems very smart and confident. But the truth is that unless you are doing some illegal insider trading, nobody really knows anything about how well stocks will do, no matter how smart they may seem. Now, maybe you're thinking at this point, wait a minute, what about Warren Buffett? And it's true. Warren Buffett's company, Berkshire Hathaway, does function similarly to an actively managed mutual fund, and under his leadership, it has massively outperformed the S&P 500 over the last 62 years. It's why he's famous as the greatest investor who has ever lived. But did you know that when you narrow the scope to just the last 20 years, even the great Warren Buffett has slightly underperformed compared to the S&P 500. Now granted, he did all while holding huge reserves of cash, which meant there was less risk involved compared to the index funds, which is impressive. But still, it is interesting how even the greatest investing mind in the world cannot beat a simple index fund consistently. So, instead of investing in actively managed funds, where should you invest your money instead? Well, as with any successful portfolio, diversification is the key, and index funds are always a great way to diversify your stock holdings and minimize risk. However, if there's ever a huge market crash, then even index funds could lose you a huge chunk of your savings. Back in 2008, during the financial crisis, the S&P 500 dropped 48% in just 6 months, and that destroyed many people's retirement savings, forcing them to either delay their retirement or come out of retirement and go back to working full time. That's why, as a part of a balanced portfolio, I always recommend my clients add something else. When I worked in Switzerland, I found that there's a certain type of investment that is popular with some of the world's wealthiest investors because it can consistently bring in returns of 8 to 14% per year, while at the same time your capital can be up to 100% protected, which means that even if the investment goes down in value, you can still get all your initial money back. Until recently, this special kind of investment had a minimum buy-in of $1 million, which meant it was only available to the world's wealthiest investors, and it was an unfair advantage they had over the rest of us. But thanks to our new advances in technology and changes in regulation, this type of investment has become much more widely available in recent years. So, if you are an expat living in the GCC and you want to safely grow your wealth without worrying about a market crash, then click this link on the description to find out more. I have been your host Khalid Shamim, and thanks for watching this video. Make sure you subscribe if you found it helpful, and I'll see you next time.